Hello and welcome to BloombergQuint. We're here with your quick budget math now that we have access to the budget documents laid on the floor of the parliament. We're going to give you a macro overview of what the economy is going to take away from this budget. So let's start with the headline numbers. Now, the nominal GDP growth number, which underpins the budget, has been pegged at 14.4%, at least in the budget documents. We're just drawing your attention to that because the economic survey had pegged nominal GDP growth for FY22 at 15.4%. The budget, at least going by the documents, says it's 14.4%. It could be a discrepancy, or they could have chosen to take a slightly more conservative estimate of growth. Now, on top of that, all the budget numbers have been built. The expenditure number is actually very interesting because the big expenditure boost, after all, did come in FY21. We kept saying the government is being restrained, but they were not particularly restrained, at least in the second half of the year. So your total expenditure has ended up at about 34.5 lakh crore in the revised estimate compared to 30.4 lakh crore in the budget estimate of FY21. What happens in FY22 is that expenditure more or less gets maintained. It increases by just about 1%. But if you look at it as a percentage of GDP, as you should, then you see that the total expenditure as a percentage of GDP comes down to 15.6 compared to 17.7% in the RE of FY21. What does that mean? It means two things. One, you did get a huge expenditure boost in the second half of FY21, the results of which we are seeing in economic data right now. In FY22, government support will remain high compared to long-term averages, but it will certainly come down compared to FY21. That's the expenditure side of the story. Government support will continue in FY22. It will not be as high as in FY21. Gross tax revenues is the next main item. There they have budgeted about 16.7% growth in FY22 budget estimates compared to FY21 revised estimates. Now, if you compare that to the 14.4% nominal GDP growth, that is actually a slightly higher than expected growth that is being budgeted. Typically, you don't do more than a 1:1 growth, 1:1 correlation between GDP growth and gross tax revenue growth. So by pegging it at about 16.7%, they are being a little bit aggressive. But again, on a year, on a percent, actually that number seems to be a little incorrect on the percentage of GDP side. So let's take that graphic off. It should that's not the correct one. But in terms of the expected increase in gross tax revenue, they are being slightly sort of aggressive. 9.95% as a percentage of GDP is what it should have said over there. Non-tax revenue, 15.7% increase year on year being budgeted. That's okay because they fell short on the large divestment number in FY21. They're hoping to make up some of that in FY22. The fiscal deficit numbers then turn out like this, which is 9.5 in FY21. So, we have to admit that going into the budget, everyone was talking about 6.5 to 7.5. At 9.5%, you know that the government actually did do that big spending boost in FY21, and they're expecting to bring it down to 6.8%. Again, the headline there is going to be fiscal consolidation, but that fiscal consolidation is going to come at the cost of lower expenditure to GDP numbers. So the government support will come down along with the fiscal deficit. Let's look at the shift in expenditure that they're talking about. The shift in expenditure is interesting because they're saying that revenue expenditure as a percentage of total in FY22 will be at 84% compared to 87% in FY21. Capital expenditure goes up as a total share of expenditure to 15.9%. That also, if you look at it as a percentage of GDP, and we are depending on Quantico research for this number, they say that capital spending to GDP, that ratio at 2.5% in FY22 is a 17-year high. Most economists say that the multiplier for capital expenditure is much higher than revenue expenditure. So perhaps some of the reduced headline expenditure support may get nullified because of the higher multipliers that capital expenditure has. Let's move on to gross borrowings now. This is actually a big surprise and very, very interesting numbers. So look, we thought the gross borrowing number in RE of FY21 will end up at 13.1 lakh crore. What the government has said is that they intend to borrow another 0.8 lakh crore, that's about 80,000 crore, in the last 2 months of this fiscal year. So that adds up to the higher fiscal deficit also that they have projected for FY21, which was 9.5%. For next year, the gross borrowing is being pegged at 12 lakh crore. Again, that was higher than market expectations. So we've seen across the board sell-off in bond markets and yields have rallied. There are a couple of sort of interesting but slightly confusing things we wanted to flag off on the expenditure side, which then adds into the higher fiscal deficit in FY21 and the higher borrowings, particularly in the last 2 months of FY21. The food subsidy number is very high. So you've got 4.22 lakh crore in FY21 revised estimates for the food subsidy head. That's compared to 1.15 lakh crore, which has been budgeted. Now, this could be because there were greater food transfers, but it could also be because the finance minister in her budget speech said that they were bringing the dues of the Food Corporation of India onto the budget. Those used to actually be borrowings that the Food Corporation would do directly from the National Small Savings Fund, and they wouldn't reflect on the budget. For a while, people were concerned about the quality of the government financials precisely because of that. So perhaps this higher food subsidy does actually reflect the bringing on budget of the FCI dues as well. I'm going to go back to the financing of the deficit. If you look at just the budget columns, the net market borrowing is coming up to 9.68 lakh crore, again, much higher than expected. The borrowing from the small savings fund is also very high. So they're expecting to borrow 3.91 lakh crore from the small savings fund in FY22, and in FY21 RE, that has already jumped to about 4.8 lakh crores. So all of this sort of forced spending, some of which perhaps goes into the small savings schemes as well, is certainly coming to the aid of the government. I want to quickly segue into some recommendations from the Finance Commission. Remember, the Finance Commission's report was also tabled along with the budget and informs the budget. Here, there's a little bit of a discrepancy again. The Commission's report says that the fiscal deficit should be at 4% by FY26. But the finance minister in her speech said it would be at 4.5% by FY26. So we're not sure whether they haven't entirely accepted the Commission's recommendations, or again, if there is some sort of a typo in the budget speech vis-a-vis the Finance Commission report. But that aside, the important takeaway here is that we're giving ourselves a fiscal long rope. We are not intending to come down to that 3% oft-repeated, long-cherished target of fiscal deficit, because even by FY26, we're only hoping to consolidate to about 4.5%. That in some ways is natural, given where you're starting from. If you're starting a consolidation from 9.5, you can't consolidate all the way to 3% over a 4-5-year period. That would be very damaging for the economy. The debt to GDP ratio, the consolidated liability to GDP ratio, is being pegged at about 85.7% by FY26. Again, a far distance away from the 60% that used to be talked about and was talked about by the FRBM review committee. So, it looks like we are going to sort of stabilize a little bit at higher levels, actually a lot at higher levels, not just a little bit, but in today's world circumstance may not be that bad. Headline for the budget, again, is one where we did get a large fiscal spending boost in FY21, contrary to the chatter through the year that the Indian government was being fiscally restrained. They were fiscally restrained during the lockdown. They have opened up the tax in the second half of the year. That's reflecting in a 9.5% fiscal deficit for FY21. They will continue some of that support. The expenditure to GDP numbers will remain high in FY22, just not as high as FY21. But certainly the negative surprise of the day was on account of the wider deficits and the higher borrowings. The positive surprise being reflected in the equity markets perhaps is that there are no incremental or huge taxation changes, no COVID tax, no ultra-rich tax, at least that we can see so far. Thanks for watching BloombergQuint. Do go to BloombergQuint.com. We've got all the top stories covered for you there.